Welcome back. You with us here on Opening Fire. You got the market, which is not doing all that well, still down about 8 odd points, 81.24. But I think let's focus on the IT space, tech in particular. Sarabjit Kour Nangra is Vice President Research with Angel Broking. Sarabjit, good morning. Good to have you with us here. Prashant this side. Now, TCS has missed expectations once again. What do you think the impact is going to be over a period of time on the growth estimates? Have you reworked estimates? And more importantly, I guess, on the PE multiple for the stock. I'll get to the actual details and the results in just a bit, but just wanted to get the stock picture out of the way.
See, as far as our reading on the numbers are, we are not very disappointed with the numbers because in the sense that if you look at deep into the breakup in the numbers, the volume growth has been around 4.9% Q on Q. Currency has played a part in terms of impacting the numbers and a bit of realization actually, which company has clarified is not structural in nature, so it's temporary. Coming to the other part of it is outlook. I guess base of TCS in comparison to Infosys is pretty large. So Infosys doing a volume growth of around 3.7% and TCS doing 4.9%. I think there's no comparison. Secondly, in terms of profitability, their margins have been in line in spite of around EBIT has been around 27%, which was in line with expectation. Net profit has been marginally lower than expectation. So I guess if I have to put the numbers in perspective, if you look at the order book position, they have indicated the order book position is 30% higher than the best average so far. So I guess outlook is positive, commentary is positive, their growth has been across the board. There is no significant single domain dependence. Most of the geographies and domains have done fairly well for them. So I guess there is not much of a cause of concern in terms of what they have delivered and also what they possibly can do going ahead. Even if you look at employee additions during the quarter, it has been significantly higher. So if I have to look at the commentary industry-wise, Infosys has also delivered its highest growth in couple of quarters. TCS has also done the same. Infosys has done well on volume front, but it is missed on the a bit. Margins again have been in line, but it's mainly driven less equally by volume and other factors. But in TCS, the growth was primarily because of volume. And outlook in both the companies has been positive. So in prima facie, I don't think there is any question of multiples being downgraded or because of this performance, at least in my opinion and my logical reasoning. I don't see TCS should any which way, given that it's the largest IT company and still doing fairly well for itself in the given environment. I don't think any reason. Profitability is the highest. Its EBITDA is 27%, Infosys EBITDA is 25%. So I think if I look at profitability, growth dynamics, I don't see any change in multiple rationale to change. Structurally, there is nothing happening. Even TCS mentioned that pricing wise, structurally this industry is not facing any downward trend. These are temporary blips which happen on a quarterly basis. So in that respect, I think if structurally everything is going, volume is definitely strong for most of the IT companies, especially the large ones which are leaders in the outsourcing industry. So as long as global environment is favorable, I think volumes will continue to come in to the large companies, and which is evident from the client wins that they have been, or the body language that they have been exhibiting in terms of a good performance going ahead also. So that will continue. So, and given that these are the two large companies, I don't think there should be a debate about the multiples as of now, because we believe that these sectors are not reflecting the true valuation given the profitability. If you look at the ROEs of these companies, these are significantly 40 plus kind of ROE businesses, which is higher than even pharmaceuticals trade at. Just to give you a perspective, Sun Pharma ROEs are roughly around on an average 30-35%, and growth is similarly, I think the company will do around 15% Y-on-Y growth, and that company is trading at around easily gets a valuation of 28 times, whereas TCS is just trading 18 times, whereas ROEs are significantly higher and growth will be around 13-14%. So I think ROE of more than 40 plus and growth of similar lines, I think there's no justification for IT sector to talk about the multiples, because I don't think they are already reflecting the true multiples. So to that extent, I believe there is no question of multiple. Yeah, there were concerns in the industry with respect to pricing.
Sarabjit, let me just come in here. Let me just. Sorry to break your flow, but just let me. What about growth, right? I agree, profitability is no problem there, but wouldn't you want stronger revenue growth and then profitability as well? What is constant currency growth expectation from TCS in financial year 16? And where is it trading at? It's trading at some 18 times. And what is growth going to be?
See, we have done a calculation on FY 17 basis. It's trading at 18 times roughly. So I guess valuation wise, I don't think there is justification. What you were talking earlier were about growth, right? So growth in this industry, when the base of the industry is so huge and it's so large industry, so the growth base effect will definitely take on. So obviously growth can't be continuously be around for IT industry 30 plus, and which we have seen in many sectors. It's not a question of IT itself. When the company matures, the growth rate tends to come.
No, I agree. And so $4 billion quarterly revenues, $15-20 million miss every quarter. It's nothing. I agree with that. But the point is, if one is an investor, you are here to make money, right? You're not here to justify that, okay, the size is so large, so growth is slowed down. I mean, that is not my concern. So as an investor, will these stocks do well? That's the point. Or do you think the multiples will slowly start to derate because growth is coming, rate of growth is coming down, has already come off actually quite a bit.
No, see, I understand your concern when you're saying that the growth historically has come down. So has multiples, right? TCS used to easily get 30 plus multiples. So now it's trading at 18 times. So how far are you going to derate a sector because of the growth momentum? And the growth can't deaccelerate. Even NASSCOM says that for next 5 to 10 years, they are easily can achieve 10 to 11% roughly growth. So the leaders will be doing much better than the industry per se, because industry consists of large players and small players also. So, but TCS has been at least outperforming and has been continuously outperforming industry growth. To that extent, I think that's what I've been trying to say. As an investor, how you make money? You make money when you buy stocks at reasonable valuations, right? Now, the sector which used to get 30 earlier, the sector has been continuously getting derated in valuation multiple terms. The profitability hasn't come down. It's just the growth, and growth is not a big component for the valuation. The valuations are driven by the profitability. It's not driven by growth. A major component of any company's valuations are driven by the profitability. That has not has seen any significant acceleration, and there are no factors which say to that it will see that happening in any near term, and that wouldn't happen because outsourcing is something which we have seen bloom in a very huge scale in many industries. Be it IT definitely has taken it forward, then came pharma. So there are many outsourcing industries which are thriving on outsourcing because of cost arbitrage, and that will not die out soon in life. So I guess
fair enough.
If the valuation driver and TCS,
you're saying that revenue growth, top line growth matters to a lesser degree. Profitability matters the most. That's basically what you're saying. I don't know. I know many who will disagree with that point of view, but anyway, that's your point of view. And this 30 times multiple was how long, Sarabjit? And we're talking about forward earnings, not trailing earnings. 30 times multiple.
Yeah, definitely. I think easily 4-5 years back, the TCS easily used to get 30 plus. I've seen it myself. Though I have taken IT very shortly, I've taken it 2 years back. I remember TCS getting valuation of 30 plus, the way Sun Pharma is getting right now. Since I track pharmaceutical, I'm taking an example from pharmaceutical, because see, ultimately as an investor, what I look at, profitability and growth, right? So I am giving you an example of Sun Pharma, which trades at, which has similar growth. Sun Pharma is easily said that it will do roughly around 15 to 16% top line growth. TCS is doing 13-15. So it's not such a huge difference, but the stock has already reacted and come down to 18 forward times. Okay, so I don't foresee there is a question of a further derating in multiples. That's what I'm trying to say. So how an investor makes money? When the multiples are already reasonable and are already discounting worse so what I'm trying to say, the growth, even if you want to factor it, it's already discounted. The sector has already come down to its valuation, wherein a 40% plus kind of an ROE business growing at 13-14% can easily give you decent returns from here on. So it's not that I'm talking about exorbitant returns, but I think decent returns can definitely be made in the sector, and especially with the top run companies. I mean, these are huge companies and these are high cash flow generating companies. These are not, these are not commodity companies.
The labor arbitrage, etc., that you made, I put that question to the CEO who I interacted a little earlier in the day. Now, there is a lot being written about automation in the US, automation not by IT services vendors, but automation in the US itself. Essentially, large companies, instead of outsourcing work, getting that work done there itself, because the reason to export work out to cheaper countries is not there because of automation. And it's anybody's guess how long this will take to become a big phenomenon, but some say we're not talking about 10 years, we're talking more like 5 years. So I put that question to the CEO. He said, well, IT companies will be a big part of enabling that automation, but will that impact growth? It's too early to say. So, it's one of those things. No one really knows the answer, and these things are changing pretty fast anyway. Sarabjit, we'll leave it there. Thank you very much for your time. Good speaking with you. Appreciate you joining in with that. Thank you. Let's just take a very quick break here. We'll come back in 2 minutes.